Hey everyone, Dan again from stocktrades.ca, back at you with another video. Some more in-depth stock research that you can really use to better your investment portfolio. This week we're going to speak about 3 of the best utility companies in the country. We spoke about one before in our best dividend stock video. I'm going to leave a link up top here. You can view that. It goes over 5 of the best dividend stocks in the country today. If you missed our video last week, I'll also include a link up top. But this video is reserved for 3 stocks that I feel are going to be key moving forward in 2020. There's a few reasons for this, and we're going to go over those before we get started with the stocks. So let's get started. So like I said, before we start the video, we want to go over some reasons why you should be looking at utility stocks in 2020. And the number one reason is the Canadian economy is struggling right now. When the Canadian economy is struggling and is set to continue struggling in 2020, you want to look for stocks that are defensive in nature, and utilities are just one of those. A lot of investors actually treat utility stocks as closer to bonds because they provide such reliable income in strong economies and weak economies because they provide power, electricity. People need this all the time. The second reason is interest rates. Utility stocks tend to thrive in lower interest rate environments, and this is because they take on a lot of debt to build infrastructure. And when rates are lower, they can invest for cheaper and build that infrastructure for cheaper. The third and final reason would be reliable dividend income. If you look at the top 5 dividend stocks in terms of growth streaks in the country, 3 of them are utilities. Number 1 being Canadian Utilities, number 2 being the first stock we're going to speak about, Fortis, and number 3 being ATCO. All of these stocks have raised dividends for multiple decades. I think ATCO is the lowest out of the 3 at 26 years. They provide high yields, they provide consistent growth, and they provide a strong defensive position for anyone's investment portfolio. With that being said, let's start with our first stock, which is Fortis. So why do we like Fortis? There's a number of reasons, but the number one reason is in terms of overall returns. They're best in class out of the major Canadian utility players with a compound annual growth rate of around 6.67%. Now the only company that really compares to this is Emera at 6.61%. Canadian Utilities has actually lost over the last 5 years at a negative 1.2% annually. ATCO sits around 0.5%, and Hydro One at 2.43%. So in terms of returns, Fortis is essentially best in class. There's one stock that's had better returns in the case of major utility players, and that's going to be our final stock in this video, so you're going to want to hang out. But let's dig in more on Fortis and why we like them. So Fortis is a market leader. There's no questioning that. I mean, they're the top utility in Canada, and they're a top 10 in North America by market cap. And they have safe and reliable cash flows. So 94% of their earnings are regulated utilities. And these earnings are considered somewhat recession-proof. I mean, people will need hydro, they'll need electricity, they'll need power regardless of economic conditions. I mean, that's probably one of the last things you would ever think about cutting back on is, shutting down your power. It just doesn't happen, and as such, these companies tend to thrive regardless of market conditions. Company has strong growth prospects, and they're expected to increase their organic rate-based growth by 7% over the next 5 years. They've also made some key acquisitions, primarily in the United States, with the additions of Central Hudson in 2013, UNS Energy in 2014, and ITC Holdings in 2016. ITC, I remember, was a pretty big purchase. Pretty sure it was over $11 billion. More business in the US also exposes them to a stronger US dollar. They have strong dividend growth. They're the second longest dividend growth streak in Canada at 46 years. They're pretty close to becoming a dividend king. That's 50 years of straight dividend growth in the United States. They're not quite there yet, but I would wager good money that they're going to get there. 6% targeted annual dividend growth rate through 2024. Highlights a yield around 3.5%. Payout ratio is 46.59, and their growth streak obviously is 46 years. They've been able to raise dividends for this long because they don't let their dividend get out of control. Analysts have a 1-year price target of $58.05 on the company, implying 6.7% upside. Out of 12 analysts, 6 rate the company a buy and 6 a hold. Now we know fundamentally that Fortis is the strongest utility stock in the country today. But with that being said, the stock is fairly expensive. It's trading at a price to earnings of around 20, which is higher than most of its peers. So you might want to wait for a dip in price with Fortis. Whether or not it gets there, it's hard to say. It's been running up as of late. Let's go over our second stock, which we've talked about before, renewable stock, Algonquin Power. So a few things about Algonquin you should know before we get started. The stock pays its dividends in US dollars. So you're going to see a dividend rate on the slideshow of 56 cents. That is in US dollars. So the stock's been a strong performer over the last 5 years with a compound annual growth rate of 13.7%. When we spoke about Fortis's compound growth rate, we were mostly talking about major utility companies here in Canada. So they have strong growth prospects as well. Their long-term expected growth rate is 6.3%, which is well above the 4.6 industry average. I think Fortis is around 4.4%. The stock has nearly doubled in the last 5 years. I mean, it has a 5-year return of around 96%. So the company's renewable energy assets are obviously a huge bonus, underappreciated in our opinion. They account for 35% of their capacity, and 53 facilities are underpinned by long-term PPA contracts. And a PPA, or power purchase agreement, is typically an agreement between a governing body and a utility company to supply power over a certain course of time, and in Algonquin's case, most of them are long-term. They have above average dividend growth. Only one of two utilities to average double-digit annual dividend growth, and they're sitting around 10% over the past 5 years. Dividend highlights the yield just under 4%. Their payout ratio is around 68%, and they've paid out dividends for nearly a decade, just 1 year shy. So they are a Canadian dividend aristocrat. They have a 1 year price target of $18.92, implies pretty much flat upside, and that makes sense. This stock has ran up a lot. I think it returned nearly 40% last year, and over the last 5 years has nearly doubled. Out of 12 analysts, 6 rate the company a buy, 1 a strong buy, and 5 a hold. It's around the same price as Fortis in terms of price to earnings and price to book, 20 times earnings, 2.3 times book. Operating cash flows obviously are nowhere near Fortis at $612 million. They're a smaller company. And like we said, that dividend rate of 56 cents, that's what you're going to get annually per share. So let's move on to our next stock, which is another renewable player and part of the Brookfield families. Quick break before we get into our last stock. If you liked the video, head down below and like it. Subscribe to the channel if you want to see more. And most importantly, drop a comment. Let us know what you think. Did you like these stocks? Did you not like them? All right, let's get to our last stock, which is Brookfield Renewable Partners. It's funny, just as we're doing this video, we got news that Brookfield Renewable Partners has put in a proposal to buy Terraform, another renewable energy company. This is going to be on an all-stock basis, and the end result is going to be the largest pure-play renewable energy company in the world. This is big news for Brookfield. It's big news for Terraform and their shareholders. But other than that, let's get into why we like Brookfield Renewable. So in terms of returns out of the pure play renewable companies, Brookfield Renewables is best in class. Algonquin had a higher compound annual growth rate, but they're not a pure play. They also have regulated utilities. And over the last 5 years, they've returned about 10.73%. Expected growth rates. In terms of a company that pays the yield that Brookfield does, I would classify this as an extremely high growth rate. They have an average growth rate of 38.2% over the next 5 years, expected growth rate. And this is the highest rate in the industry by quite a bit, I believe. So they formed a new corporation as well. The creation of the BEPC will expand its U.S. investor base. It'll make them more appealing to retail investors. It's going to increase liquidity through broader index and ETF inclusion, and also institutional investors who might not have been allowed to own units, partnership units, or just preferred not to, will have access to these now. So dividend growth. Dividend accounts for only 87% of funds from operations. And if you're unsure of what funds from operations is, it's essentially a different way of calculating the cash flows of a company. A lot of REITs use funds from operations typically because it takes into compensation one major thing, which is depreciation. A lot of companies, depreciation is a bad thing. Their equipment is depreciating, but in terms of a REIT, real estate really doesn't depreciate. It's an asset that holds its value. So they typically use funds from operations. The company expects to achieve 5 to 9% annual dividend growth and a 70% funds from operations payout ratio. So it sits at 87% now. They're planning to lower this down to 70%. The company yields around 4.36%. They have a payout ratio of 87%, and they've grown dividends for a decade straight. They have a 1-year price target of 63.18, which implies 11% downside. Out of 12 analysts, 2 rate the company a buy and 10 on a hold, and we view this as a, much like Fortis, a buy on the dip candidate if it does dip. So, Fortis, Algonquin Power, Brookfield Renewables. 3 utility stocks you need to be looking at in 2020. All of them provide excellent dividends, especially in the case of Algonquin with the fact it pays in US dollars. Fortis with their long dividend streak, 46 years. They're the biggest utility company in the country. They've provided long-lasting returns. And Brookfield Renewables for the high growth rates and the pure play renewables, which is a huge thing moving forward as we divert from fossil fuels and towards renewable energy. As always, like the video, subscribe to the channel, and like I mentioned in the break, comment and let us know what you want to see. But that's it for this video, and we'll see you next week.